But essentially when I'm thinking about rebalancing or just all the topics that we're covering today, and of course, coming back to confidence again, to me, confidence is, doesn't come from predicting the future. It comes from knowing how we're going to respond to it. So even with a great plan, diversified investments, we know that the market can drift. And that's where rebalancing comes into play. And it can be really hard to do as we've gone through all of these, even in the last 20 years, various market events. Being able to say, hey, I know the market's down, but we're going to take something from a more conservative area. We're going to move it back into the things that were down can be kind of challenging. So we do want to make sure we're focused on that disciplined rebalancing process that helps our clients buy low and sell high in a more measured and consistent way. So that looks like when one area of the portfolio outperforms, we trim it. And then when another area lags, we just add to it. So Jordan, do you have the ability to show, do you have the slideshow up?
I do, yes.
Okay. Okay, I can't see it. So in any case, you can see it? I can't. Okay, I think the first one, if I recall, and let me just grab my copy of the slides here, but it's talking about when the market has a 10% or greater drop, what is the estimated annualized return after that? So I think the first one was like 11.7 over a 1 year period. Then it jumps to, I think it was 10.3% over a 3 year period. So essentially what we're looking at is, what we are knowing with a lot of this, again, evidence-based material, is if we do have a market that goes down and we know that the market's adjusting, or whether 10, 20% or greater drop, that evidence is showing us that it will come back. We almost always know that. So this again goes back to, we have to stay consistent and stay invested, and we also have to be able to focus on and consider rebalancing. So Jordan, if you can hit the next slide, we're going to look at what portfolio drift can look like. So this is a little example during COVID. I know, I can't believe it's been 5 years, but this is an example of what a portfolio would have looked like. Let's just say if we were to take a 60-40, we know 60% is allocated toward equity. If we were to have the last rebalance for that portfolio on December 31st, 2019, just over the course of that first quarter, already our portfolio has drifted to probably about 55% in equity. And then after the markets recovered, if we did go ahead and rebalance on March 31st, we go back to 60%. Then by the time we hit June, the end of the second quarter, we've already drifted and we're out of balance. So a couple of things, we probably want to do rebalancing when called for and not just waiting for a quarter, which is something that we do. But then you can kind of see in real time that if your plan or your design was built on, I need to have this strategy of a portfolio, be it 60-40, 70-30, whatever we're calling it, we do want to continue rebalancing on a regular basis so that we can stay consistent with that strategy, because drift happens, not just on the allocation, but even within the investments. Go ahead and hit the next slide, Jordan. So we should be looking at why financial planning guides investing. So this is actually a snapshot. If you've done financial planning with us, what you're looking at is the asset spread for a client's lifetime, say this year going all the way out until they're like 100 years old. This is a sample case. We have, Mr. and Mr. Smith's sample client here. The planning we do, so if you're from Florida and you're aware of the planning for hurricanes and spaghetti graph models that we all watch as we're preparing for a hurricane, it gives you a spread of where is this thing most likely to fall? And that's kind of what this page shows us. So it includes about 1,000 different iterations of various markets, inflation, rates of return, all kinds of things can happen because we know planning doesn't look like we get 7% every single year. So we have to take that into account. And this particular model is showing us that, Mr. and Mrs. Smith are both fully going to be retired at 67, 65 years old, how much money they have, and then what we're projecting it to look like all the way until their passing. Now, what we haven't seen was before this, we had to make some adjustments to get here. Maybe we had to save a little bit more. Maybe we needed to adjust what their allocation was, but we got to a place where we were successful. And so this is where I come back to, if we've already planned for, again, 1,000 different scenarios, up and down markets, a variety of things to happen. If we have a plan like this in place, this is what gives our clients confidence to know that I don't need to worry about what's happening on a day-to-day basis because I have this plan that I can lean back on. Go ahead and hit the next slide for me, Jordan. So just to kind of summarize some things here, or at least with, investing with a purpose, as we're talking about rebalancing as well as investment, then, investing can feel emotional, especially if there is no plan. So we don't want decisions to feel like a guess. We want to be able to put our plan in place. It gives us direction on what to expect. It gives us direction on how and when to rebalance, how much risk we need to take. So, the last line here, without a plan, volatility can feel like chaos. With a plan, it's just part of the design. So people are knowing what to expect. And again, that brings us back to a lot of confidence.